No, we got too much stuff on the go. And we're probably going to get going now. We got a good number of people that's attended, and you guys were on time. So we wanted to make sure that we get started on time. So as I was saying in the first place, reverse mortgages is what we're going to have on the agenda today. As everyone can see, I am not Kyle. Kyle is away. But if you've had any of these webinars in the past, probably 6 to 8 months, any of the time that Kyle's away. My name is Justin. I'm the lead broker, the lead trainer at his group of companies. So I usually am the one who steps in and kind of takes the reins as far as the webinars during the time that he's away. So reverse mortgages is what we wanted to do today. We brought in an expert on it for you guys as well. So you're going to have a great voice, an experienced voice, giving you guys all the information. So feel free. He's going to take over, and I'm probably going to be manning more of the Q&A. So feel free to load up the questions, because I know the guy who's given the conversations loves all the questions that he can get, and he's nodding and he knows. So feel free to load them up. We'll have a big Q&A at the end, as is typical, and we'll try to run through all the answers and questions that you guys have asked during the program. So if I could ask for the next slide, that would be great. And we are going to just kind of get going. Yes, next one, please. Perfect. So what we're going to be doing today, table of contents, obviously we're going to be going over the reverse mortgage basics. We're going to be going over typical uses and creative uses, because there is a difference. And then we're going to be going into Victor. Victor is our guest speaker today. He is from HomeEquity Bank, HEB, and he's going to have lots of insight. So like I said, feel free to load up the Q&A, because that's going to be a great piece in this. People do presentations all the times, but I always find the most value in the questions that are asked from the people who are going to be using the product, or from brokers who are going to try to sell it. So from Victor, we're going to go to myths and facts. He's going to be talking about opinions to finance, home equity over time. We're going to do a couple examples, and then we're going to go into some Q&A as was discussed. Next, please. Oh. Perfect. One back. Thanks, Victor. So what is a reverse mortgage? So a reverse mortgage, it's a loan secured against the value of your home. It's designed exclusively for Canadian homeowners aged 55 or better. It provides up to 55% of your home value. This money is tax-free. No impact to government pensions. No mortgage payments are required. Although Victor did give us a presentation. I was lucky enough to listen to it a couple weeks ago, and there is an option to make a payment. Keep an ear for that, because it is an interesting piece. And then you maintain ownership and control of your home, which is a super big, important piece. And we're going to get into that, especially when we get into the creative financing. What can you do, and typical situations that are going to allow you to retain control of the home. Next slide, please, Victor. Typical uses. So providing... Sorry, guys, my webcam is in the wrong spot. Providing additional cash flow is one of the big ones. Again, I'm not going to go in and I'm not going to elaborate on these too much, just because Victor is going to be the one who's touching base. He's going to be the one who's got his, iron in the fire every day. So he's going to have the best way to provide you guys with the most information that we can. Helping people stay in their homes, of course, that's a huge thing with any reverse mortgage, CHIP especially, and providing alternative methods of qualifying for a mortgage where income is not a factor. So yes, right, you can purchase. And again, I will let Victor explain more on that, but purchases are allowed as far as the Canadian Home Income Plan goes, not just refinances, which is what we mostly get talked about. But again, it's another point and another piece that we should know if you guys are going to have the most information and make the best decisions possible. So creative uses. So creative uses, we're going to go into real estate or invest in real estate. And there you go. I wasn't sure how we set it up. So yeah, that's perfect. So you can use it to buy a rental property, no payments on the reverse mortgage, which of course you can earn cash flow on the rental, have capital gains on the value of the rental, and you can write off the interest accumulation on reverse mortgages. So again, I'm sure he's going to touch on that. But what I just want to do is I just kind of want to set you guys up right now, put some information in your heads, get you in that reverse mortgage webinar mindset before I pass you along to Victor, who's going to have a lot more details on this. So early inheritance, of course, another creative and excellent use for this. Real estate is difficult to qualify for and super expensive today. Grandparents and parents plan on handing down assets eventually. So early inheritance. So instead of selling off the mortgage, they put on a reverse mortgage. They're then able to provide their, kids, grandkids, whatever they're looking for with that early inheritance, and be able to maintain control of their home. So equity lending with most major banks has kind of disappeared. That's just kind of the the environment, the rate environment, the mortgage environment, the home sale environment that we're in right now. So only age and property, location type, et cetera, are used in underwriting. And it's something that only private lenders usually use. So flexibility, right? Flexibility with the Canadian Home Income Plan is an awesome piece of this. And again, it's something that should be considered. I know lots of the times anything reverse mortgage kind of gets a little bit of a negative connotation on it sometimes, but that's just not the fact, and it's not the case. And I applaud you guys for taking your time to learn more about it today, because it has some awesome uses and some excellent things that can actually save, whoever you're either helping or helping yourself. Next, please, Victor. So there you go. So an in-depth look at the examples. And what I'm going to do is, because biographies are important, because it's important that we know who's speaking to us. And Victor wrote such a nice long one that I'm just going to read it out to him and just put him right on the spot. So Victor Chang is a business development manager with HomeEquity Bank, which is the oldest and largest and most trusted provider of reverse mortgages in Canada. In a role with this company, he partners with mortgage professionals to help educate Canadians on the benefit of the CHIP reverse mortgage, an exclusive program to HomeEquity Bank. So Victor holds a business degree in real estate and accounting from the University of British Columbia. He has over a decade of experience working in the investment industry with extensive knowledge in mutual funds, insured investments, venture capital, and private equity. He has a fond interest in helping Canadians live and financially plan the retirement of their dreams, which is what attracted him to his current role. In his spare time, Victor is a serious foodie, and prior to COVID at least, traveled the world as a gastro tourist. On weekends, he enjoys keeping active by hiking the local mountains in the summer, and is an avid golfer year-round. So, Victor Chang, I'll let you take it from here. And again, thank you very much for joining us.
Thanks, Justin. I would say thank you for embarrassing me, but I guess I wrote the thing, so thank you for embarrassing myself with the biography. But thanks for everyone coming to attendance tonight. Really wanted to discuss this really, really cool topic of CHIP reverse mortgages. And for those of you that have never heard of it before, or only heard it from Google searches or what you've heard from friends, the program itself is very, very different today than the way it was in the past. And, a lot of it was news coming in from the US, a lot of myths, which I'll go through, and I'll go through some of the facts associated with our program. HomeEquity Bank, we've been doing this for 36 plus years. We're recently acquired and owned by the Ontario Teachers Pension Plan, which I believe is the 18th largest pension in the world. So, deep pockets, a conservative style, ownership structure. And all we want here to do is, try to educate retirees. And if you're younger, looking at this program potentially down the line for yourself, or looking at it from your parents' perspective to see if there's a fit for the program within your family. I always say it's not a program for everyone, but in certain cases and situations, it is a great solution. So going down into a little bit of a deep dive now is going to give you guys a lot of content on this program. Feel free to ask all your questions in the chat channel, and Justin will interrupt me when he needs to interrupt me if there's a influx of questions coming in, and I can stop in and handle some of them. So how does it work? It is only available to clients that are 55 and older. The payments are optional. Okay. So one of the most common things is, clients or, Canadians go, okay, we don't like the idea of reverse mortgages because the interest compounds on itself, and soon I'll have no equity left in my home. If you're really, really concerned about compounding interest, you can make payments. You can make up to 100% of the interest payments on a monthly basis. You don't have to make all of it. You can do half of it, or you can do all of it. You can also pay down 10% of the outstanding balance once a year on the contract's anniversary date. The reverse mortgage program itself is a lifetime program. So when you sign up for it, it goes for the rest of your life, or as long as you own your home and don't sell your home. With that said, within that program, you can, pick different interest rate terms, whether you want a variable rate, a 1-year rate, 3-year rate, or a 5-year rate. The other thing about reverse mortgage is that, we don't really care about income or credit. We would qualify the client regardless of their credit score or income, and it doesn't actually impact how much we can lend, which is really, really important, because when we look at the scope of different types of products that are available in terms of, taking equity out of, a client's home, you have a few options. If you can get a HELOC or a secured line of credit from a major bank on your property, that's fantastic. The rates are probably going to be the lowest. It's not, 2% anymore. Unfortunately, it's probably closer to 5 or 6%. But if you can afford the interest and principal repayments, and you're not too worried about it, and you can qualify, and you need quite a bit of income to qualify these days for a home equity line of credit, that's great. Go with that. If, on the other hand, you are looking for something with, a 70% loan to value or 80% loan to value on your property, and you need that to finance something, that's fine too. You are probably looking at the private lender space, and their rates are going to be, fairly into the double digits these days with the rate of interest rate increases. Here's an option where we say, here's a payment optional or no payment mortgage. The interest rate kind of sits in the middle. You don't have to income or credit qualify. Would you like to hear more about it? Right. So that's the limited income and credit requirements. Ability to unlock up to 55% of the value of your home in cash. So how we achieve this is on a few criteria. The number one criteria that depends on how much we can lend you is the age of the client. So if you got a mother or a father, or you're at that age that you're 55 plus, we are going to loan you less if you're 55 years old versus if you were 90 years old. And the thinking behind is that most of our clients actually don't make any payments. We'll never force you out of the home. So a 55-year-old could potentially be in that home for the next, 40, even 50 years, right? And so, yes, interest is accumulating, but at the same time, our bank is not recovering any of our invested or lent money out until that client leaves that home. Right. And so obviously with an 85 or 90-year-old, the time span, the life expectancy is a lot shorter. So we can loan you that, up to that 55% threshold. Second criteria is obviously the value of the property, but the location of the property. In Greater Vancouver, you don't need to worry about that too much. It's all what we consider a lending location, but you will get a little bit less if you're out in Kelowna or if you go up into northern BC, where home prices don't appreciate as fast as, say, in Greater Vancouver. Type of home matters as well. A single detached has greater ability to increase in price, so we'll loan a little bit more on single detached. We'll loan versus townhouse versus condo. Those are pretty much the main criteria for lending on the reverse mortgage side. What actually happens is the funds can be advanced as needed. So if we had, if you've got a $2 million home or a $3 million home, or it doesn't matter what you have, and we say, hey, you qualify for $500,000 on a reverse mortgage. If you only want $100,000, that's fine. We initially advance you $100,000. The other $400 just stays with the bank. On a future date, maybe a year or two later, you need another $100,000, then we give that to you. At that time, we'll release it to you within 72 hours. Usually we can do the processing and have that money in your bank account. Interest is only charged on the amount that you have withdrawn, right? That's the most important thing. We're not charging you interest on what we approve. We charge you interest on the amount that you've withdrawn. Finally, a couple other things. The proceeds are tax-free, which is, I think, a huge benefit of reverse mortgages and equity lending out of your home. The proceeds are tax-free, and we'll get into a little bit of that in more detail. Penalties are waived during death. Because the mortgage is lifetime, we do expect our clients, for the most part, in all except one of our programs, to keep the reverse mortgage for at least 5 years. So within the first 5 years, there is a penalty table if you do decide to sell your home in the first few years and pay the reverse mortgage back. Won't get into too many details about that. Obviously, reach out to Justin and his team for further information on that. I got one quick question here. What happens if you have parents and children on the title? That is a really good question, Vinny. Typically, it doesn't work because the kids are going to be generally under 55. If the kids are over 55, yes, we can lend on that, but we would have to use both of the ages. What happens if, a lot of times the family will come to me and go, okay, well, the kids are okay removing themselves off title so that we can lend the money to the parents. That's fine as well. We can do that in one transaction, one lawyer meeting at the end. We remove the son or daughter off title, and then we do the file on the reverse mortgage on the parents' age. Okay, common myths and facts. Number one, the bank owns my home. I don't know how many clients I talk to, every year that says, oh, I don't like reverse mortgages because the bank owns my home. The reverse mortgage is still a mortgage. Just like you have a mortgage at TD or RBC or HSBC, which soon to be RBC, you maintain ownership of the home, right? All we are is, a charge on the title of the home. Now, we do have to be in first position, so that the only other thing you have to consider is, do you have an existing mortgage? Okay. If you have an existing mortgage, will the chip be enough to pay it out completely and then possibly give you a little bit more money? So we do have to pay out everything else on title. If chip can't for some reason give you enough money, we can look at a private second mortgage on top of it, which is fine. But we don't own your home. You own your home. The only difference between a TD mortgage and us is if you stop making payments on your TD mortgage, guess what's going to happen after a few months? They're going to want to foreclose on your property. Because we don't require payments on our mortgage, we actually can't foreclose on your home, which addresses question number 2. The only time where you could get into a little bit of a problem with our bank is not because you didn't make any mortgage payments, is if you stop making payments or stop insuring your home. We don't like that, because if something happens to your home, we have no recourse to get the money back, right? The other thing is if you stop making property tax payments, that's a problem as well, because that could obviously be in arrears unless you're deferring property taxes, which is fine as well. We do have to pay it out during that funding process, but you can continue to defer it into the future. You have to keep your home in a hospitable, livable environment, so no walls and things falling down and holes in the floors or anything like that. And the only other thing is strata fees. We have to make sure you keep up with your strata fees, because again, it could cause a lien on your property. Number 3, myth. Upon the eventual sale of the home, I or my beneficiaries will owe more than the house is worth because of the compounding interest, and I haven't, made any payments. I'm afraid that, down the line, when I pass away, my home is going to be worth maybe $1 million. It used to be worth 1.2, and the market's come down. My home's $1 million, and all of a sudden, this chip reverse mortgage is $2 million. Well, I can sell my kids will sell my home, but they may still owe you $1 million. That is not true either. What we have on the CHIP program is what we call a no negative equity guarantee, which means that we guarantee that the value of your property so the value of your loan never exceeds the value of your home. So in the event that it does, you just continue to stay in that home until you decide to sell, or in most cases, you pass away. The estate sells your home for $1 million. They pay HomeEquity Bank the $1 million. The additional $1 million that's owed, as a bank, we write that off, and we're insured against it. And that's the no negative equity guarantee, and that's basically written all in the legal contract that our clients go and sign at the end of a reverse mortgage process. So, when you think about that, then you begin to understand why we won't lend a 55-year-old, 60, 70% loan to value, is because we know that program is going to go negative. And when it goes negative, we lose as a bank. So we're very, very conservative in our lending practices to keep everybody safe. Final myth here is reverse mortgages are a lender of last resort and should never be trusted. Not true at all. I think traditionally we have this lender of last resort idea because clients always thought that, okay, I get into credit card debt, I'm owed, I don't have any income. The only place that will qualify me to pay out my credit card debt is, this CHIP program. What we're seeing over especially the last 10 years, is multiple uses for the reverse mortgage. I talked to a lot of financial planners. I came from that financial planning background. More and more planners are starting to use this program for alternative investment ideas, alternative income planning, retirement planning ideas, and I'll get through some of that today. One question here, does it matter how long I have owned the home? No, it does not. Very simple. 4 different options of the reverse mortgage. CHIP Reverse is the flagship program, which is our one-time lump sum option. Whether we approve you for $500,000, you take $100,000, or you take all the $500,000. That's the CHIP Reverse mortgage. You want to, pay off debt. You want to pay off your existing mortgage because you're tired of making mortgage payments. You want to renovate your home. You want to gift your children a lump sum. That's the CHIP Reverse mortgage. Chip Max is basically a higher loan to value or higher octane version of Chip Max. That's something that we would get into a conversation with your mortgage broker in terms of how much you need. If you don't qualify for enough on Chip Reverse Mortgage, Chip Max may give you up to about 30% more, but the interest rate is a little bit higher as well, about 1.5% higher than the regular Chip mortgage. The third one is Income Advantage. We'll get into a case study on Income Advantage, but for clients that are looking to potentially just take an income stream, right? Maybe they take $25,000 or $30,000 to pay out, some existing line of credits or whatnot, and then they go, I just need $1,000 a month. So Income Advantage is designed to provide that income stream for clients. And finally, the Chip Open is a short-term lending solution. The first three programs, like I said, in the first 5 years, if you sell your home and pay off the reverse mortgage, there's a penalty. With the Chip Open, there is no penalty. You can pay it off at any time. So where we're seeing that utilized is short-term lending, bridge financing, and we'll go through in a scenario with that as well. Okay, so Chip, when it's time to find a better home, our first case study, our first scenario. You got parents, or you're maybe in your 70s already. I'm not sure how many people we have in their 70s on the call here, but if you've got parents in their 70s or maybe even 80s, and they're living in a $600,000 condo, or maybe they're living in a $2 million home, it doesn't actually matter. They're not happy living in that home, or that home has served its useful life, but they're stuck in it and it's unrenovated, or maybe the strata is going to come in with a huge assessment to replace the roof, and the parents this couple doesn't have any money, right? So they're becoming increasingly unhappy living in there. Meanwhile, we got COVID, and God knows what the next pandemic is, forcing them to stay in this home because they don't want to move into a retirement facility. So you think of all the solutions of situations where, older couple may not be happy in that home, and that home is not serving them. So what are their really options are they going to move into a new home and potentially, pay for a new mortgage? No, they can't make mortgage payments. They're on a fixed income, right? And so they're stuck in that home. So what we can do is, in this case of the 72-year-old couple, is that we can actually upgrade them on a new purchase to a $900,000 condo in their neighborhood that they've grown up in over the last 20, 30 years, right? All of a sudden, they're in a brand new build, and we need to just finance them about $350,000 because they can sell that old condo for $600K and have that $600,000 down payment. So we give them a $300,000 Chip Reverse mortgage. They don't ever have to make payments for the rest of their lives as long as they're in that home. So it's a win-win situation for everyone involved, right? When we think about that. In Vancouver, where I am, I'm not sure where everybody else is, I'm not working too many on the 600,000s. What I am doing is we're seeing a lot of, what we call these Vancouver specials, the $2.5 million big lot homes with a big old home that's, 30, 40 years. And the clients are not happy in there, it's not renovated, and they're moving up to that $3 million range. And we can make the numbers work because they have a $2 to $2.5 million down payment. They're only looking for a $500,000 mortgage. That's not a problem for us to finance. Again, no income qualification, no credit qualification. Income supplement. So this is where I was talking about our Income Advantage program. And before I even talk about this case study here, the solution here, we got to look at inflation right now, right? It's crazy. The government of Canada is jacking up interest rates to control inflation, but it's still hovering in that 7 to 8% range. Meanwhile, gas prices are up, food prices are up 25, 30%. Clients that are older clients that have a mortgage that are renewing their mortgage are going from 2% to 5%. So what we're hearing all the time is that, oh my gosh, I could barely, keep my cash flow stable when mortgage rates were 2%. Now I have to pay 5%. Well, guess what? I have to stay in my home. So I'm going to make my mortgage payments. And then I'm going to go into credit card debt on my groceries and putting food on the table and paying for gas and medical and all that other stuff. And they max out their credit cards and then they call Chip because they don't have anywhere else to go. We could have avoided this solution a long time ago by setting them up proactively for a Chip Income Advantage program, right? So we look at Mrs. Holland here, 72 years old, struggling to balance her cash flows, and her daily expenses have gone up 30%. Pension income, old age security doesn't increase 7, 8% a year. It's relatively stable. So it's not like the government's making up for high inflation by giving, the retirees more money. right? She doesn't want to go into credit card debt because we know that's horrible, 25% interest, right? A lot of stress. Moving would also mean, leaving her community and neighborhood that she's lived in for decades. So what does she do? She calls us. We go, okay, well, your home is worth $1.2 million, right? What we can do is set you up with a chip income advantage. We're going to give you, say $25,000 up front to pay off some lines of credit or whatever you have. And then what we're going to do is give you a monthly tax-free deposit of $1,200 into your bank account, or whether it's $1,200 or $2,000 or whatever it is, you need to balance your cash flows on a month-to-month basis. So she's super happy because we found a solution that doesn't require her to make payments, doesn't require her to go into credit card debt. And is it expensive? Yeah, we're at pretty much, 30-year or whatever high interest rates. But when we look at this solution here, we look at year 0 to 10 on the left-hand side. Let's put some numbers to this, right? And we do a reverse mortgage for $25,000, and we're adding, about $14,000 of income every single year, $1,200 a month times 12 months to the reverse mortgage balance. So in this second column here, we're adding $14,000-ish a year. Interest rate is, 8.39 on the $25,000 lump sum, and then we actually increase it after this third year just to be conservative. Our expectation is actually this will most likely drop back down after the Bank of Canada has done their a little interest rate rising program. The plan advances, so this is the income component, the $1,200 a month, has to be actually done at a variable rate because we can't fix $1,200 in every single month. It'll be an accounting nightmare. So we do this on a variable rate basis, and right now it's 8.9%. But what does it look like over time? So what we've done on, still focusing on the first row here, if your home grows at say 4% a year over the next 10 years, at the end of 10 years, your $1.2 million home will be $1.7 million. Your mortgage balance, your accrued interest goes from zero in the first year to about $23,000 at the end of, $23,000 a year at the end of the 10th year, right? So that means that the estimated amount, including accrued interest, compounding interest, at the end of 10 years, stacks up to be about $289,000. Well, you know what? This is not bad. Considering your home's now $1.7 million, you're actually going to net out still about $1.48 million. So as a summary of the values, what we're doing here is, yes, your home is 1.2 today. It's 1.7, in 10 years at a 4% growth rate. Your reverse mortgage amount is $25,000 you withdraw today, plus $1,200 a month of income for 10 years equals $169,000. Your interest is about $120,000 at the high interest rate we are at now. Historically, we were between 5 to 6%. At the end of the day, when we pay off the reverse mortgage, you still have $1.48 million left. So in this situation, we see that even at 8-9% interest, the interest is not growing as fast as the value in your $1.2 million property. So we ask, why wouldn't you do this? Why would you get into credit card debt versus looking at this potential option of a tax-free income solution? Reverse mortgages. We love the bank of mom and dad. We do a lot of it, and honestly, it's not about rating your mom and dad's, home and equity they built up through their whole lives. It really is not. It's actually looking at it from the standpoint of, can we take some money out of my parents' home and generate wealth for the entire family? I'll talk about generating wealth quite a bit to the next series of slides here. We always want to talk about intergenerational, like not just you generating wealth, not just your parents generating wealth, not just your grandparents generating wealth, it's the entire family. How can we create a better wealth generation scenario? So in this case, back to mom and dad helping the adult kids, right? We've got Mr. and Mrs. Patel here. They have a home, they've got a modest investment portfolio, they're doing okay. Kids are fully grown, the parents are living in Vancouver, and the kids have had a baby, a grandson or granddaughter, and the kids go, well, I can't live in Vancouver close to my parents. The homes are too expensive. So I'm going to move out, to Langley or Abbotsford or Chilliwack, which is, not great, right? The parents go, yeah, it's really tough buying real estate, where we bought it, 10, 20, 30 years ago. Right. It's also very expensive for my son or daughter to raise, grandchildren. I also want to see my grandchildren not once, a month because they're out in Chilliwack. I want to see them 3 times a week, right? So, as a family, they decided that, banking mom and dad might be a great solution, right? If we back out a step and we look at, where 30-year-olds, 40-year-olds upsized or bought their first homes in Greater Vancouver the last few years, Chilliwack market values have gone up substantially over that, first 2021, 2020 period. But now this year, they've come down about 20 to 25%, right? Versus Vancouver hasn't fallen as much, right? So we got to say, where's a better place to buy as well, right? So after speaking to a financial advisor as well as their mortgage broker, we've decided on this chip reverse mortgage program as an early inheritance. Also remember, if you have parents here that have been here for 30 years, it's like winning the lottery, right? And I always say 2 things. If you won the 649 for $2-3 million and it costs you 7 to 8% to take the money out to help your kids or do whatever you want, would you wait till you die and then have your kids, take it out for free? Or would you want to spend some money now and invest in your children, invest in your grandchildren, invest in that yourselves? And clients always go, oh, yes, of course, I would take that money out. It's only 7 to 8%. I won the lottery. Well, so you did win the lottery. It's called the Vancouver real estate market, right? Your home was, when you bought it 20 years ago, was $300,000, $400,000. You paid off the mortgage. Now your home's $2 million or more, right? So we got to think about it from that perspective as well. So let's put some down conversation about down payment helpers a little bit more, just down payments in general. We want to talk about the true cost of down payments, right? Have this discussion with prospective, referred clients all the time, right? When you are taking money out for a down payment, you really have a few sources of areas where you can take. Typically, it's coming from your RSPs or your RIF, or whether it's coming from stocks or mutual funds, bonds, GICs, and cash. All of them have a cost, or you can take it from the home on the other side of the vertical line there. So, first of all, what's the investment return? Well, an RSP, if you're invested in a conservative portfolio, because typically it's your safe money, you're returning anywhere from 2 to 10% in RSP. You got stocks and mutual funds. Yeah, maybe you're returning a little bit more because you're a little bit more aggressive in the tech stocks, whatnot. You're returning, on average, 5 to 12% a year. Bonds, GICs are relatively safe, but you're not going to earn much, 1 to 5% return a year. Cash, well, cash is free. So we're going to consider cash as zero. But realistically, when you think about it, if you've got cash in your bank account, how did you get that cash? Well, you had to have grown it somewhere and then withdrawn it from somewhere. There's costs associated with that withdrawal. We're not going to factor in that in here. Let's just say if you've got cash in the bank account, it doesn't make any money, it doesn't cost any money, all right? You got your home. Investment return on a home over the last, say 15, 20, 30 years in Vancouver, is probably closer to 6%, but let's just say 4% conservatively. The other thing is we got to pay tax, right? So from a tax standpoint, if you're withdrawing from your RSP or your RIF, unless you're a first-time home buyer and using that, $35,000 free money, first-time home buyer plan, you're paying 100% income tax, right? And income tax anywhere from 0, which is very, very rare, to 47%. Stocks and mutual funds, if you sell stocks and they've made money, that's great. You got to pay capital gain tax. You're going to end up somewhere in the 25% range. Bonds, GICs, produced interest income. Interest income is 100% taxable, right? So 100% tax at your marginal income tax rate on any withdrawals that you make out of the bonds and GIC. Cash, let's just say cash is 0 again, all right? So what's the cost? What's the tax of moving money out of the home? It's actually there's no tax, right? It's the equity you built up in your home. We're going to give it to you for tax. This is the first job and first company I've worked for that I've never seen a tax slip in the 3 years that I've been here, which is great. Opportunity cost, interest cost on their value. So what I mean here is, well, if you withdraw money from your stocks or your RSP, what is the opportunity cost? The opportunity cost is that the money is no longer growing, right? If you have $100 and you invested in, Apple and you withdrew that $100, that Apple stock is no longer going to move up from $100. It's not doing anything because you've withdrawn it, right? So the opportunity cost, yes, it's 2 to 10% for RSPs, 5 to 12% for stocks because you're not invested anymore, 1 to 5 for a GIC, and nothing for a cash. You withdraw cash, you never grew cash, and you're never going to, lose any cash by withdrawing it. So what about the home? What's the opportunity cost on the home? Well, if you withdraw $200,000 or $300,000 from your home, it's not like we slice off a bedroom and now instead of a 4-bedroom home, you have a 3-bedroom home. It's still a 4-bedroom home growing at 4%. So the opportunity cost really on withdrawing from the home is really only the interest rate, and the interest rate hovers somewhere between 5 to 9%. 9% is higher than what it is now, but we're getting to that stage there, but we don't see it going past 9% anytime soon or into 2023. So then what do we look at? We look at the total cost, right? The total cost of these things start to stack up. When you add the lost cost of the growth of the investment plus the tax on an RSP or RIP, you get 2 to 57%. Your cost per dollar is 2 cents to 57 cents per dollar you withdraw. For stocks and mutual funds, it's 30 to 37 cents. For bonds to GICs, it's 1 to 5 cents. Cash, well, cash was free. We're saying if you've got cash, use it. Costs nothing. But the home, total cost, there you go, right? 1 to 5 cents per dollar. So what happens is you got $4 of growth in your home minus the $5, 5 to 9% charge for the interest. You end up with 1 to 5% total cost on the home, or 1 to 5 cents per dollar withdrawal. So when you do your analysis on, your personal down payment helper, if you're looking to buy a home, upgrade a home, or your parents are looking to gift you some money, always ask, where is that money? Not where is that money coming from, but what is the cost of that money? What is the cost of that down payment? And pick the cheapest option. So we look at this 65-year-old couple. They've got a $2.5 million home in Vancouver. It's free and clear because their mortgage was paid off many years ago. Maybe it was only $300,000-$400,000 mortgage, and Vancouver lottery, the home's worth $2.5 million. Son's 38 years old, has a planned down payment. He goes, oh my God, I've saved up $100,000. I can now go buy a $1 million townhouse in Langley and live 45 minutes from my parents. Parents go, no, we don't want you to do that, right? We want to give you $200,000. Which is 8% loan to value. Like, we're not taking 50% of your parents' value in their home. That's their money. That's the equity that they built up, and that's used for their retirement plan, right? We're only going to take like 8, 10, maybe 15% from the parents. Say, call it 8%, $200,000 to purchase now a $1.5 million townhouse in Vancouver instead. So the parents say, I want my grandkids closer to me, right? What does this look like? Well, if the son or daughter does not have a helper, then you got a $100,000 down payment. Max home value you can buy on a $100,000 down payment is actually $999,999, say $1 million. We grow it at 4% a year. After 10 years, that $1 million home is going to be $1.48 million. With the helper now, if the parents are gifting the son $100,000 and $200,000, and the son's got additional $100,000, now we have a $300,000 down payment. The max home price goes up to $1.5 million. We grow it at 4%. After 10 years, that home is worth $2.2 million. So 2.2 minus 1.48, there's a gain of $740,000. But wait, the parents had to pay interest. Okay, interest at 8% over 10 years accumulates over to about $238,000. Right? So we got to subtract $238 of interest from the $740, and we get a net gain of $500,000, or equivalent to an annual return of about 10%. Right? So, that's the benefit of leveraging, is a term that, is otherwise known. Leveraging your parents' home to get a tax-free down payment help to get you into a bigger home, a better location home. So it has the chance of growing over the period of 10 years or 15 years. We look at the parents' home on the bottom right side, home value today, again, $2.5 million. In 10 years, at a 4% growth rate, your parents' home will be 3.7. The reverse mortgage originally taken out was $200K. Interest over 10 years at 8%, it's going to be about $238. But the remaining equity is still $3.2 million, right? So there's money now and money later. Okay. I got a question from Rod here. How does a reverse mortgage differ from a line of credit? If you're talking about a secure line of credit or home equity line of credit, the home equity line of credit is cheaper, right? But you have to make interest and principal repayments. So if you're taking money from your parents and maybe they have a 3, 4, or 5%, HELOC in place, because if they don't have one in place and they're retired, they're not getting the new HELOC, right? They won't qualify. So they have one in place. Yeah. If you guys are comfortable as a family, whether they're paying it or whether you're paying it, the interest and principal repayments on it, that's fantastic. But the thing is, what happens if you become unemployed? and your parents are on fixed income and they can't make the payments anymore on that HELOC, what happens? The bank calls it back, and now you're on the hook for, 200,000, 300, whatever you've withdrawn, right? So you got to analyze and assess the risks of that line of credit. If you all of a sudden can't make payments anymore. With the reverse mortgage, you don't have to make payments. I always say to clients, the adult children, hey, if you wanted to and you can afford to make interest payments on your parents' reverse mortgage, go ahead. Just send us the money. We'll auto debit it from your bank account and pay off the interest on your parents' reverse mortgage. After 5 years, if you've saved up enough to pay off the whole thing, pay off the whole thing. Right? It's up to you. You don't have to, but this is your early inheritance. I'll give you, just a very quick story. Working for an Amazon, speaking to an Amazon employee last year, he, in a nutshell, he was about to withdraw $400,000 in employee stock options, pay the tax to get about a $200,000 down payment. I mean, the opportunity cost there was huge. I said, why don't we do a reverse mortgage for your parents? And instead of withdrawing $400,000 from your Amazon shares, right now, why don't you withdraw $20,000 a year and pay off the interest on your parents' reverse mortgage? At the end of the year, your stock's back up, and then you withdraw another $20,000, right? So, different ideas there. Question, can you use this service to purchase a home, or must you own a home already? Yeah, we do new purchases. That was one of the first things that we talked about, is that if you are, if you have a down payment yourself, like say, you have a $600,000 down payment, you're looking for an $800,000 home, yeah, absolutely. We can finance $200,000 for you. You don't have to have an existing home. We'll do new purchases all day long. I've done dozens of them this year. Chip open, okay, bridge financing. You got couples, parents in that age group that it's time for retirement, and you realize that this is a really good opportunity right now in a buyer's market to buy a condo that we can move into. But you know what? I don't want to sell my single detached, which is worth more in a buyer's market. I want to sell my single detached in a seller's market, maybe next summer, right? When things get a little bit better on the economic side, right? So this retired couple, 72, realizes that it's a great time to buy and look at downsizing. Even though the rates are high, remember this: it's more advantageous to purchase at a lower price today at a higher interest rate than it is to purchase at a higher price tomorrow at a lower interest rate, right? I'd rather have, if I'm looking on the market for a $3.5 million home, I can't afford one, but I'm just saying, hypothetically, if I was looking for a $3.5 million home, maybe I'll be able to buy it for $3.1 million today. If I wait till next year, it's going to cost me $3.8 million in a bidding war. I'm happy to pay that temporarily high interest rate because I know it's going to come down because it's a self-inflicted interest rate increase by the government. I know it's going to come down over the next 2, 3, 4, 5 years. Why wouldn't I take advantage and get a lower home price today? So the couple here needs to maximize the funds they can borrow to carry both properties at the same time, but because they're 72 years old, they don't want to make any payments. Again, we look at Chip, right? I don't want to debt service $1 million condo and make monthly payments because I don't have any money to do that. So the solution here is we do that bridge financing for this 70-year-old couple all the way. $2.6 million property. They found a home that they're going to downsize into. So on their current home of $2.6 million, we're going to loan them that $1.1 million to act right away, purchase that condo, no payments to make. They move in, take their time, stress-free. They don't want to have to move in one day. They don't have to line up, selling dates and all that kind of closing dates. They can move in. They can take a month to move in if they want to. Once they're comfortably moved in, and maybe next summer when the market gets a little bit better, they sell their single detached home. But the other thing we have to realize here is oftentimes these single detached homes, when we see it, they're not renovated, right? And for a 72-year-old couple selling a single detached that's possibly 20, 30, years old, unrenovated, they're not going to get as high of a value because it's not another 70-year-old couple that's moving into that home. It's a 40-year-old couple with 2 kids and a dog, and they don't want to move into a rental project. So maybe with the Chip open, we have enough money in the pocket to help them renovate that home while they're not in it, do all the kitchens, bathrooms, maybe we put some, stage furniture in there. And instead of selling that home for $2.6 million, maybe we sell it for $3 million. Right? So that's the Chip open. They can pay it back anytime, no penalties. I hope you guys are all keeping up. I'm going at a lightning pace right now. There's tons of different ideas, just as long as you get the general scope of it. I'm sure you can reach out to, the Green Mortgage team, and they can go into each of your situations in a little further detail. This is what we call proactive downsizing, new mindset. Okay. When I talk about this is, if you're 65 years old and you're just retired and you've got your single detached home, the traditional plan is that you withdraw money from your investments. Right? You withdraw money from your investments until you run out of investments. And then you go, oh, thank God I'm living in Vancouver or Toronto. My home is worth millions, so I'm going to downsize into, also a multi-million-dollar condo. And then, hopefully I'll have enough money from that downsizing to not run out of money again, even though, my parents are still alive and they're, getting on almost up into the age 100 category. So am I going to live a long time? I hope I don't run out again from downsizing. And I share this as, honestly, a personal example. My parents right now are 76 and 74. They downsized last year from a $1.5 million condo to a $1.5 million home to a $900,000 condo. They cleared about $450,000 through that downsizing. How long is that really going to last? They ran out of money. They got $450K in the bank right now. My grandma in Richmond is 99. My other grandma in Shanghai is 102 this year. So my parents are going to live forever, right? $450K is not enough. And eventually they're probably going to end up moving into my brother's home. So meet the Camp family, same situation. 65-year-old couple, free and clear home, $2.5 million. They don't want to downsize right now. They say, oh, I'm still happy. I got grandkids running around. I'm doing babysitting, whatever. I don't want to downsize. We'll just wait till later when we run out of money. So they got a son and daughter, 40, 37. This son and daughter is really great. They're doctors and lawyers, so fantastic. Not every adult son or daughter ends up as a doctor and lawyer. The parents themselves were just blue-collar workers. They immigrated here 30 years ago, bought their home for, $500,000 or something, paid off their mortgage, and now, Vancouver real estate homes quadrupled and quintupled in price. But they worked very, very hard to pay off that $500,000 mortgage and have $200,000 saved up, with their investment advisor or with TD Canada Trust or with RBC. That $200,000 is actually the Canadian average investment savings for a 65-year-old couple. I know it seems low, but I can guarantee you there's a lot of 65-year-olds that don't even have $50,000 in their bank accounts on retirement. We know the current situation for the average 65-year-old couple is that they actually run a shortfall of around $2,500 per month. What I consider a shortfall is, look, I'm retired. I have a company pension, maybe not. I have CPP. I have old age security. I still need $2,500 per month to balance my gas and groceries and living expenses. All of a sudden, I have an unexpected, housing expense, whether it's $25,000 to replace the roof, or my car breaks down, I need to buy another car. Where is this money coming from? This money is coming out of the $200,000 that they saved up. So says their financial advisor. Well, if we start doing the math and they start withdrawing, $30,000 a year and a $20,000, $5,000 one-time withdrawal, by the time that by the time they're 72 to 77 years old, that investment account will be zero. And then just like my parents, they downsize, right? Option number two, you could ask the kids for support, right? Okay, well, can you pay for your parents? Can you give your parents $1,000 a month for babysitting support? Maybe, maybe not. Can you afford to give, maybe between you and your sister, give your parents each $12,500 to help with the repair of their roof or buy them a new car? I don't know, man. A lot of kids these days are having their arms outstretched with, hey, can you help me with a down payment? Or hey, can you even help me make some mortgage payments because I hit the trigger rate on my variable rate mortgage? And not be like, hey, mom, here's, a lot of cash to help you with your retirement, right? So at the end of the day, this 65-year-old couple, they don't want to downsize today, but eventually they will have to for financial reasons and increased living expenses, which everyone is experiencing these days. If you look at a chip reverse mortgage, and here you'll see the term HomeEquity Bank equity release, an equity release program. Doesn't that sound better than a reverse mortgage? Actually, that's what they call it in many parts of Europe and in Australia. Equity release programs, right? All we're doing is releasing the equity out of your home. Backing out one step here. You spend 30 years or however many years buying mutual funds and putting it into your RSPs. You spend 30 years, putting money into your home by making mortgage payments. But for some reason, at age 65, you think it's completely normal to withdraw money out of your RSPs and pay, 30, 40% income tax, and it's not appropriate to withdraw money out of your home that you've also saved up for and put money into as an investment, and that money is coming out tax-free. Why? It doesn't make sense, right? So this $2.5 million home for the 65-year-old couple qualifies for, about an $800,000 equity release program. They can take $25,000 of it, go fix their roof, buy a car, right? The other $800,000, why don't you go and purchase a 2-bedroom rental condo in Burnaby or wherever? You can be you go into Calgary, maybe you can buy two-bedroom, condos. I'm not saying move into it. I'm asking you to proactively downsize by buying it today and renting it out. So your rental income all of a sudden is $3,500 a month. We know rents are, sky high right now in Vancouver. You pay your property taxes, your strata fees, whatnot. You end up with $2,500 a month in your pocket. So you don't have to withdraw it from TD Bank in that $200,000 investment safe account. You don't have to ask your kids for support. You've got renters that can pay you that $2,500. Now, the interest rate is not great right now. I'll be the first to admit it's around 8%. Part of that is going to be deductible against your rental income. So if you are declaring $2,500 a month of rental income a month, you can declare $2,500 of interest expenses. Your effective interest rate is reduced. But at the end of the day, forget about the interest rate. Look at the solution. I need $2,500 in my pocket. How am I going to get it? Can you do this with a HELOC? No, because with a HELOC, you have to make interest and principal repayments. With this program, you don't have to make those repayments. So that's actually pure money, pure positive cash flow in your pocket. Fast forward 10 years, value of the home, of that single detached home, grows at 4% a year. Now the parents are, 75 years old, and they go, hey, you know what? I'm tired of being in this home. Our income is okay because I've got that rental income coming in every month. And by that time, it's probably more than $2,500 a month. But you know what? There's no more grandkids running around. They're all old, out of country. Maybe they visit us once a year during the holidays. There's too much maintenance, too many spare bedrooms. I'm tired of it. Let's get rid of it. And what does that look like? Well, that 75-year-old client at 10 years later, that 75-year-old client is going to sell that home for $3.75 million. Even if the reverse mortgage rate is at 9%, what they're going to pay back is $2 million. So your $825,000 original chip plus 10 years of interest compounding at 9%, that's about $2 million. You still net out $1.75 million directly into your bank account, right? And so, at first, some client goes, well, something's wrong with that. I started with a $2.5 million home and now I only have $1.75 million. Well, have you forgotten about the $2,500 a month that I've given you for 10 years? And have you forgotten about the fact that you bought this condo for $800,000, when you were 65 and now it's $1.2 million and it's free and clear, right? Don't forget that side of it. And oh, by the way, so now we're looking at it, you're living in a $1.2 million condo because you're going to kick the renters out because you want to downsize, right? So you kick the renters out, you move into this 2-bedroom condo, it's $1.2 million free and clear. You have $1.75 million of cash in the bank account from the sale of your single detached home. You've collected $300,000 of, rental income over 10 years, which I'm not even going to include here. And that $200,000 that was at TD Bank that you had in mutual funds, because you didn't have to withdraw that $2,500 a month, because you didn't have to withdraw that $25,000 to buy that car, the financial advisor has now grown it to $300,000 in 10 years. So all of a sudden, you go from a situation where I am in a forced downsizing situation because I've run out of money, and even on the downsize, I'm not guaranteed that I'll have enough money saved up from the downsizing to take me into my 90s. To now I've got $3.25 million of wealth in my name, right? We take this one step further. At 85 years old, that condo is going to be worth $1.8 million. If you use all the money, that's great. That's pretty hard to do. But even if you didn't, we can still do another chip for you at 85 years old and give you another close to $1 million at, a 55% loan to value. So now you're looking at another $1 million to potentially help your children or your grandchildren, and you're building that legacy, you're generating that wealth. I hope that makes sense to everyone. I've got one final one and basically 5 minutes to go, and then hopefully Q&A. I hope everyone can stick around for a little bit longer. This slide is interesting. I thought about taking it out for clients that don't need that $2,500 a month. If you don't need the $2,500 a month, I mean, you could technically take that $800,000 and go, leverage it and buy 3 $700,000 pre-sale condos. It's only going to cost you 20% deposit, so $140,000 each. Give one to a child, flip a second one, whether take the third one, you flip it, rent it, live in it, give it to a second child. That's great. I'm not saying to go out there and do that. I'm just getting you guys to think that you've got money in this house. Whether you buy extra property or whether you buy a vacation home in Palm Springs or whether you buy mutual funds or you go buy Tesla, Apple, Google, Facebook stock or whatever you want to do, take that money out and use it. If you can generate a return, why do you let it sit idle in your home? Final concept of today, right sizing. Okay, so when we look at right sizing, we look at clients that are maybe in a better financial situation and they're looking to downsize because of space. The single detached, 3,000, 3,500 square feet, it's just too big, too many bedrooms. So they go to a realtor and go, I'm ready to downsize. And the realtor goes, oh, that's great. Do you want to buy a condo or a townhouse? Do you want to climb stairs or would you like an elevator? And the client goes, no, we don't want to climb stairs. So then, the realtor goes, here's 10 condos, right? Pick one. Really, you're doing yourself a disservice here from an investment standpoint. If you have identified that the cause of your downsizing is space and not financial, why are you downsizing from a single detached to a condo when you can actually downsize into a duplex, but buy both sides of the duplex? Or in this case of a real world example, this client in Vancouver about 3-4 years ago came to us and saying, this is my plan. Here, I'm going to have my developer friend build a fourplex. I'm going to make the garden level suite because I don't want to climb stairs, concrete surround, the rest is going to wood frame because I don't want to hear the neighbors when I rent it out. Right, so him and his wife move into this garden level suite with a concrete surround. Developers built this fourplex and the developer goes, if I build this fourplex, how are you going to buy all 4 units? Well, that's easy. At 75 years old, we can lend them a little bit more, right? We can lend them maybe 50%. So on a $5 million fourplex that the developer is selling, he's got a $2.5 million down payment from the sale of his home. So he needs $2.5 million of financing. Here's Chip on a new purchase, right? You want to buy a $5 million home? You got a $2.5 million down payment. We're going to release the equity out of your new 4 properties combined because we can blanket all 4 properties together and give you a $2.5 million Chip reverse mortgage. So now all of a sudden you bought this fourplex for basically no money out of your pocket, right? And so when we think about it, he moves in, hires a property manager, rents out the other 3 units, and he's collecting $10,000 to $12,000 a month from the 3 rental families that are in there beside him. This is great. He goes, I don't have any financial problems. I'm just investment savvy. I'm going to take the $10,000 to $12,000 a month of rental income, and I'm going to pay down the interest on that Chip reverse mortgage. So what ends up happening is instead, when this client passes away down the line, instead of inheriting that condo that the realtor was about to sell that client, maybe it was $1.5 million when he bought it and it's $3 million on his death. Now he's got a $5 million fourplex that can be $10 million or $15 million, on his death. And where do the kids, which one is going to give a larger inheritance to the children? The fourplex after they sell it or the condo after they sell it, right? And this is, again, the wealth generation story about leaving a legacy for the children. That is the end of my presentation. I know it was a ton of content here. I want to flip it back to Justin here to see if there's any other questions I can answer. If not, we're happy to close this meeting today.
Yeah, no, that was great, Victor. Thank you very much. I don't see anything else that's come up. You've kind of answered them as they came. So typically we keep them on the side and then do the Q&A at the end, but you were proactive on the whole thing and just answered the questions as they came. So that's great.
I've got a giant 40-inch, LCD screen that I stare at. So I've got 5 windows open to see everything. Perfect.
So if anyone, there you go. So we got a couple questions coming in right now. So feel free if you can see them on your end.
Okay, so can CHIP be offered if you have a HELOC? Unfortunately, no. So a HELOC is a home equity line of credit, which is secured against your property. So again, with the CHIP reverse mortgage, we have to be in first position. So if you have an existing HELOC, we would pay that out and we would close it off so that we can be in first position.
Perfect. For me, do you have restrictions on owner-occupied and rental properties as far as a purchase goes?
For new purchases, what's the easy way to do it? We loan on primary residence only.
Okay.
So at least one property has to be primary residence. So can we lump in a rental property? Yeah, absolutely, I can. So I'll give you an example. 2 weeks ago, I did a $4 million chip reverse mortgage for an 85-year-old client. He had one primary residence on Cambian 40th, worth $3.8 million, and he did 2 rental properties worth $2.2 million each. He had a bunch of mortgages on them, 6 of them actually, most of it private, and we condensed all 6 into one giant chip reverse mortgage. He's using his rental income to pay down the interest on the chip reverse mortgage. So we can do inter alia blanket financing across multiple properties, but one of them has to be your primary residence.
Okay, that's awesome. And the other thing that I had, I do see Mike, if you want to address Mike Pierce's question in the chat first, that would be great.
So HELOC. It depends on the HELOC. Justin, you'd be more familiar with the HELOCs. What's the repayment on the HELOCs these days?
Repayment like interest, and a HELOC is an interest-only payment option.
Yeah, so I guess nothing has changed. I'm not sure if there are principal repayment HELOCs still out there.
I mean, you can choose to pay off as much principal as you like, as long as that interest is covered. That's why it's an open product, right? So
I think the big thing with the HELOC is, one, do you have one, and will you qualify for one? Because we have a lot of retirees just say, I just go to RBC and get a home equity line of credit, and we say, go ahead, see you in a couple of weeks, when RBC says no, because we know based on their income and where they are in their life, they're not getting one. The other thing with HELOCs is the banks can call them, right? Once it becomes non-profitable for the bank to give you that HELOC, they can say, no, you got to pay it all back, right? And that goes back to how you're going to pay it back. If they actually, worst comes to worst, they want it. With our program, we can't call it, right? As long as you make, like I said, as long as you make your property tax payments, if you're not deferring it, have home insurance and make your strata fees if you have one, keep it in livable condition, we can't, legally, we can't take your home from you or call it a chip reverse mortgage. So,
perfect. Ricky, yes, we typically post the webinars on the Green Mortgage team's YouTube page. So if anyone doesn't have access to that, feel free to reach out to us at the info address and we can give it to you. Alternatively, just go onto Google and search Green Mortgage Team. It's probably the only one that's going to come up, and obviously has lots of the webinars and Kyle's stuff that he puts on. We have lots of people that go on and visit it quite often. I don't see any other questions. If anyone has any, though, please feel free to reach out or ask Victor right now while you got him.
If you guys were paying attention, I'm glad I answered everything, because I literally I know a lot of times, like, we'll come into individuals that won't tell anybody everything. I basically err on the side of caution, and I tell you, the most answered questions are the ones that you don't even know about that people ask, and to stay ahead of it, be very, very transparent with everyone.
And for me, I think it's typical. The most interesting thing in here for me is always typical uses versus the creative uses. Right? Because it's the same thing on like the investment side of real estate, right? It's figuring out what everyone is doing and then finding out how to do something a little bit different for your advantage, right? Which is always a good thing to know. Victor, if you have any comfort or if you have any questions about any of the reverse mortgage stuff, if you want your qualifications done, if you want any of those ran, please feel free to reach out to the info@greenmortgageteam.ca. And we have 2, 3, 4 people on the other end that are ready to man those calls and to address any questions that you might have on this. Victor is someone who comes and visits our office as often as he can. So our whole team is very, very up to date on everything home equity related, home equity related or reverse mortgage related. So any questions or concerns, please feel free to just reach out to someone on Kyle's team directly. As that would be kind of your best bet, as Victor is a BDM for that. So he doesn't really take calls from anyone other than brokers. Is that right, Victor?
It has to go through a broker.
That's what I thought.
With the client, we do it together usually or whatnot. But unfortunately, I can't disclose my work information. Although you're welcome to look me up on LinkedIn and message me.
Looks like if I have $1 million in cash and want to buy a new home, how much of a mortgage could I get? I'm 62 years old.
I think right now, somewhere between, I would say 1.3 million. That's my best guess anyway. 1.35 million is what we're looking.
And that's just solely based off of the how much down payment they're going to be putting towards whatever type of property they're.
Basically what I'm looking at. Okay, 62-year-old. I don't know. Husband-wife situation. We own differently. I'm assuming it's a single detached home. I don't know. I'm assuming it's Vancouver. I don't know for sure. Our lending on $1.3 billion would probably be about, $300,000 to $400,000 lending on that. So if you've got $1 million down payment and we give you $400K, $300K, we're in that range.
So pretty ballpark numbers, Perry, but like I said, if you have any questions, feel free to reach out to that info at Green Mortgage team that's up on there right now. And we can definitely elaborate on what you qualify for. Like I said, it does have things to do with deal specifics, not just to age. Obviously, age is one restriction that does need to be met, but location, situation, circumstance, all that stuff gets kind of piled in there when a decision is being made. But like I said, reach out, call, text, email, whichever way you are easiest to get in touch with us, and we're happy to help.
And also, Perry, I don't know if you own a home because, it depends on if you just want to finance the new home or you actually want to, finance the new home and also get financing, on your current home. Because again, we can blanket both properties. So lots of different options there. Okay.
No,
it should be about 1.3, 1.4 million.
Perfect. Does anyone have any other questions? Well, I don't see anything coming up right now, Victor, so I'll take this time to say thank you very much. I'll let you get on with your night. 8:08, so this is the perfect time. Once again, thank you very much for helping us out with this. I know Kyle appreciates it. I very much appreciate it. Everyone that you listen to appreciates it. And again, hopefully we'll be able to have you back soon.
Great, amazing. Thank you very much for that.
Awesome. Thanks, Victor. Have a great rest of your night. And thank you, everyone who's still around. And as I said, the recordings are going to be up probably sometime tomorrow around noon. So if you wanted to watch again, please feel free to look them up online. Thanks, guys.
Half speed.
There you go. Yeah, don't speed it up. Awesome. Thanks, Victor. Thanks, everybody. Have a great night.